Welcome in and welcome back. We are here for the weekly investor number 12. We've got 4 stories to talk about and then 3 stocks that I will be watching this week. The number 1 story to talk about, if you have been on YouTube at all, you know that Trevor Milton has been everywhere in the wake of his company going public. His company being NKLA Motors. And one of the places that he was to be found on YouTube was Tesla Daily, on which he gave an interview. And the most notable nugget to me from that interview happens, I believe it's about 10 minutes of the way in. I jotted it down in a note when the interview very first went live, and did not go back to to see the time. So I apologize for that. Please forgive me, but. Yeah. So NKLA recently went public. They merged with VTIQ, and went public. Now, NKLA is a hydrogen fuel cell vehicle maker. I believe they also advertise some vehicles which will be electric. Now, I haven't gone too deep into the other vehicles they offer. What they are most notable for is the semi-truck that they will be producing, which is a hydrogen fuel cell model that is supposed to make the long trips extremely easy. The most notable thing to me that Trevor said in this entire interview was when talking about going public. Now, I want you to remember what this company does. This company is hypothetically a hydrogen fuel cell vehicle company, a mass transit hydrogen fuel cell vehicle company, an electrical vehicle company, which means a battery company. And these are the extreme innovation. These are on the bleeding edge and cutting edge of technology. And he said the most difficult thing he's ever done was go public with that company. Now, far be it from me, who only knows of these technologies through the wonders of YouTube, far be it from me to assume that I am correct in assuming this is vaporware. This company and this CEO simultaneously claim to be completely vertically integrated, which is one of Tesla's big selling points, as well as one of the interviews he did, I don't think it was with Rob Maurer, I think it was a different interview, but he said one of the big things you've got to be good at in life is understanding when you're really bad at something. So we outsource the things we're really bad at. And when you look at their business, they're about to outsource goddamn everything. So it is confusing for this individual to be saying that we are outsourcing all of the things we're bad at, and then look at the number of things they're outsourcing and understand that this is a comprehensive business. Another thing that he was quoted at saying in one of these interviews that he's done tons of interviews recently, is that the Tesla fanboys get angry when you out Elon. Now, this isn't a direct quote, but the out Elon thing is a direct quote. And I don't know what he means by that, because this company looks like vaporware to me. The next story worth talking about, Qualcomm, ticker QCOM, has been getting some revised forecasts, and many of them are bullish. I believe it was 22 out of 30 were buy ratings on the company, as well as Rosenblatt Securities, which gives a $105 price point, a $105 target, citing the 5G potential with the company. This is a company which is primed to really take advantage of the 5G revolution. And I think they are currently $85 to $88, if I am not mistaken, maybe a little bit more, but it would not surprise me if over the next couple of years, this not only becomes a $100 per share company, but $140 to $160 per share company, depending on what part of that pie they grab. Because I think a lot of the projections for the 5G revolution might be on the underside. I think that there will be a much higher adoption of this than many of the analysts are allowing. And I think part of the reason for that is going to be that this 5G revolution is going to be playing simultaneously into communications as well as the AI revolution. And the more they can get their name on 5G in general, I think Qualcomm is going to be able to really put their stamp on that next generation. And they have seemingly put themselves in position to be at the forefront of future revolutions as well. So it's going to be interesting to see exactly how this goes for that company. A report out of CNBC, at least that's where I caught it, states that the market is at a valuation which is a forward valuation of the market, which is at a 19-year high, which doesn't necessarily sound all that dastardly until you take into account that 19 years ago was the tech bubble. The tech bubble ruined the entire market for the better part of a half decade. So if that is in fact the case, we've got some things to watch. My question with this, now by the way, the analysts working on this story still predict that the market will go higher. In fact, I can't remember the gentleman's name, but he said that basically all of the money from the Fed has just provided a bridge over 2020. So nothing's going to count. Nothing's going to harm the market unless it causes harm after 2021, after 2020 into 2021. So that is interesting. That is an interesting little nugget to sort of roll over your tongue. What does that mean for anyone who is able to emerge from this crash as a victor, right? If they are able to enter 2021 with momentum, what does that do for your stake in the market? But what I want to know, banking is still depressed. Tech never got the jump that they wanted. Retail is still depressed. Dining is still depressed. I don't remember if I said, was banking the first thing I said? Regardless, entertainment is depressed. This market being so high, this forward earnings multiple being so high, these PE ratios being so dastardly right now, and still looking so out of shape, so inflated. Where are all those numbers going? With all those sectors depressed, who is it that got all them? Is it simply Amazon, whose valuation is sky high? And if so, I don't know if Amazon's valuation really is sky high. Look at all the things they're doing and innovating and creating to this day. So it is. I don't know where that's going. The final story to talk about is one that is of personal interest. 2009, I believe, I got into Fannie Mae at $0.25 a share. And I've been waiting for this company to go back to be reprivatized, to exit conservatorship. Apparently, Fannie Mae and Freddie Mac are nearing their exit from conservatorship, and one of the big rules, the big hurdles that they have to overcome, is raising $240 billion, as well as having 3.85% equity to asset ratio. And the $240 billion mark might be as low as $135 billion, apparently by some loophole. And if you see the numbers that these companies are bringing in on a quarterly basis, it's possible that these marks will be reached sooner than not. And it has long been known that the Trump administration wants Fannie Mae and Freddie Mac to exit conservatorship and be reprivatized as soon as possible. So I think what's going to happen is, as the election approaches, Donald Trump is going to sort of dangle this carrot out there that, look, I wasn't able to do anything in my first term, but on my second term, what I'm going to do is I'm going to reprivatize these two companies, because that is going to be a massive boon for the stock market. And there are Democrats, I can't remember the gentleman's name, but there are Democrats who say they don't want Fannie Mae and Freddie Mac reprivatized. They want it to be a government-run thing from here on out. And I'm not sure why that is. There's a couple reasons, I think. One is just control, and with control comes money, and with money comes control. But the other is it becomes a further way to socialize the state and socialize housing. And I don't see that happening. So those are, the four stories. Now we've got three stocks that I'll be watching this week. Number one is PepsiCo, ticker PEP. It is currently around $132 with a 52-week high of $147 and a 52-week low of $101. The drink and snack behemoth is roaring back to life. And though I do hold Coca-Cola, ticker KO, I rue passing on Pepsi when I saw it at $101. I remember seeing it on that day and passing on it. Now, I elected to go with Coca-Cola, who is very diverse in the drink market. One thing that I didn't know, they own Glacial Smart Water. They own Topo Chico. They own the new AHA water, of which there are two caffeinated flavors, caffeinated sparkling waters. I've tried the green tea and honey one, I think it is. Green tea and something. Pretty good. Decent stuff. Not bad. I really do like Topo Chico, though. They're not as diversified, however, as is Coca-Cola. Coca-Cola obviously owning Frito-Lay, so they own a lot of snacks as well as the drink part of that company. I am not sure. I'm not sure how I feel about the future of those companies, because I see the United States and the world, indeed, moving away from these syrupy drinks. But when they move away from syrupy drinks, lots of people like carbonation, and carbonated water is a fad that is growing and sees no end in sight. What is the upside to that? When you don't have to add a syrup to your carbonated water, it's a lot cheaper to produce. So it is going to be interesting to see where this market goes, and if that revenue, if that profit margin, if the margins of these companies go up and up and up, and whether or not one of them decides they're falling behind and decides to buy Fizz, which is the maker of La Croix sparkling water, or if they decide to just keep so 3 years ago, Coca-Cola bought Topo Chico, and they spent a pretty penny to do it. So it'll be interesting to see if there are any more smaller but important grabs to be made. The second company I'm going to be watching this week is IBM, ticker IBM. Who'd have guessed it? They have a $134-ish price point at this moment, but their 52-week high is $158.75, and their 52-week low is $132. $1.32. That would be extreme. But their 52-week low is $132, so they're trading much closer to that 52-week low than they are the 52-week high. Now, with the Red Hat acquisition of a couple years ago, I believe, they were putting their best efforts into becoming a cloud play, which, if you really think about it, what IBM's massive problem was going forward is that they were masters of the old cloud, which was not a cloud at all, but big machines. So as that has become decentralized and destabilized, in fact, in that market, IBM has suffered. But with the Red Hat acquisition, they put their cloud efforts on steroids. But what I want to know is how much growth is actually left to be had in that field, which is already led by the likes of Microsoft and Amazon. Those are heavy hitters. And when you're already paying out a 4.87% dividend, you're banking on growth, and you're banking on growth, A, with the 5G revolution, and B, in your cloud computing capabilities. But it makes me wonder how much growth there is to be had in those, and whether or not IBM can return to the place where they become a market leader, a thought leader, and a company that is aiming to revolutionize their own the sectors in which they are playing. The third stock I am going to be watching this week is another one that I have been ruining for 2 months. Darden Restaurants, ticker DRI, is currently trading at around $87 with a 52-week high of $128 and a 52-week low of $26. Let me repeat that. A 52-week low of $26, a 52-week high of $128. A $102 disparity between their 52-week high and 52-week low. And this was exclusively due to the COVID pandemic. This is an incredibly stable company, but an incredibly stable company that counts on butts in seats. And they did not have any of that. They currently pay a 4.01% dividend, however. And that's pretty good, despite the fact that they've already over tripled in their rebound. So I almost bought this when it was in the 30s, and I figured I had time, so I was making other investments. It turns out that I did not. I did not have time, and I should have done that then. This is the company that is responsible for Olive Garden, Red Lobster, and Longhorn Steakhouse, among others. And the reason that I think this might still be a company that is worth watching and possibly worth pulling the trigger on. A 4.01%, a 4% dividend isn't anything to hold your nose at. So that's one. But two, this has always been a stable company. It's been a stable grower. And I think, I think that there's two ways to look at a growth company. One is the traditional definition of a growth company, a new company revolutionizing a field. Number two, we've had a lot of stocks that hit multi-year lows due to this pandemic. Essentially, if they get back to what they were, you're looking at percentage growth numbers that are similar to a growth stock. So another thing worth watching in this company is they have for so long been an industry leader, maybe not the industry leader, but an industry leader, that you have to imagine they want to return to that place. They want to return to prominence, and they're going to find ways to innovate within their own space. What does this mean? It's hard to say. But Olive Garden has long been known for gimmicks, right? Mix and match pasta or seasonal drinks or things like that. I contend to this day that Olive Garden is responsible for Sparkling Moscato reaching the crescendo that it did. And Sparkling, if you don't work retail or work with liquor, about 6 years ago, Moscato hit the fan. And about 4 years ago, sparkling Moscato hit the fan. And you had problems keeping on your shelves as all of the Beckys in town wanted to get drunk. But those are the 3 stocks that I will be watching this week and the 4 stories that I covered on the Weekly Investor 12. I hope to see you next week for the Weekly Investor number 13.